over a long period of time. This one, yes, that's directly inflationary as well. It's going to hurt their dollar reserves on the other side of the coin if they start selling their T-bills to the Fed or anywhere else, actually. Yes?
On the radio, they said the bond prices went up. You know,
Well, the yields went down, the price went up.
yeah, and so that's inflationary, right? Let's see.
No, that in and of itself, yeah, it depends on the inflationary. That in and of itself, the announcement of the price of the Treasury bill itself operating on the market system is not, the impact inflationary or deflationary is so minimal in those changes, like I said, because you're talking about long-term bonds. These are 30-year bonds. So that change in yield is a relatively low effect, right, over time. But I want to get, like I said, I want to get past this because there's still quite a few things to cover here. Actually, during the time when I was acting as an engineer on all these different projects, I mean, it's just like I think the basic thing people don't understand about the difference between Austrian economics and Keynesian monetarist or real business cycle economics is the fact that Austrian economics is concrete. And it's concrete for one reason, because it's based on what's called praxeology. Praxeology is the study of behavior. All the other economic sciences are fundamentally based on what's known as econometrics. Okay, meaning some type of a statistical, or what von Hayek, the Nobel Prize winner in 1974, Friedrich von Hayek, who was one of the lead Austrian economists in the world, said the scientistic view. It's a combination, it tries to be a combination of science and statistics, and it fails at both. And in the Keynesian monetarist view, like in that graph, you can see the Keynesian view fails miserably at every turn, as does the monetarist view, because the only difference between the Keynesian view and the monetarist view, right, is we think we can manage and manipulate by controlling an interest rate the behavior of an economy. And 99 times out of 100, the problem is, thank you, the problem is that economies, if you have a centrally managed currency, you don't have a free market by definition, because free markets require free currency, free market currency, competitive currencies. As soon as you set up a centrally managed currency, believing that you can manage the behavior of a free market, what have you done, right? Well, I mean, is a Mustang trained to the saddle and the bridle a Mustang anymore? No, it's not. It doesn't, there's no, I mean, it's so oxymoronic to think that you can have a free market without a free market currency that underlies the entire system. If you think you can centrally manage a free market through a currency, you're dead from the get-go. Some of these evolutions take 100 years to complete, which is what we're seeing right now, but they do complete, they do close. So let's take one of the fun ones. And here's the other difficulty that's going to be faced, and it's a very practical problem that's being faced right now in the industry, and I know this from talking. I have been at, since 2001, I'm no longer in the network. I walked away, what wasn't done was done after 9/11, and I walked away from Wall Street entirely after 10 solid years. I lived in the World Trade Center for 270 nights at the Marriott Trade Center Hotel. I lived, breathed, and ate that complex for the last 5 years of the 90s. One of the more interesting networks was the Citigroup network. This is the operational assessment. As chief engineer, when I would go into a project, first thing I would do is order an operational assessment. And everybody runs out and they collect all this documentation. They start filling up rooms of documentation. Then what I have them do is I have them break it down into a summary document. It tells me basically what the network as a whole looks like. This is the top level document that was handed to me as in my engineering group as the central operational assessment. We called it Project Sleepy. And it encompassed a lot of things. Basically, their network, we started working on it in '99, and that was one of the things that when they were finishing up with the merger of Travelers, which we were already into. We went from Citicorp, Citibank to being Citigroup when it merged with Travelers. And when I got to it in '99 and started working on the worldwide migration of all of their financial platforms, let me tell you, sometimes just one reason that the too big to fail thing has got to end is too big to fail. When it fails, is really bad. And when banks like Citigroup and all the others out there start coming apart, one of the most difficult things to deal with is when all their systems have to start being dismantled. In their network at that time, this is, like I said, this document's from '99. At the time that I took on the project, the numbers that came back, they had 135 different in-country operations. They had 2,700 branches and growing daily. They had 5 operating regions that were North America, Latin America, Caribbean, 4 divisions. Latin America, Caribbean division, Europe, Middle East, Asia, Asia Pacific. Okay. Those 4 regions were then divided up in 135 countries that they had physical bank presence in, and bank networks was 135 countries. And then of course you had, some countries, they had 1 or 2 branches, the little countries. Some countries like Germany had, I think, almost 300 Citigroup or Citibank branches. Then we had to combine all the financial networks. When you look at all of those different networks, those networks are comprised of hundreds of different platforms, trading platforms, the processing platforms, electronic transaction platforms. In New York City, in Manhattan alone, Citigroup had 33 different processing centers in Manhattan alone. Okay, they had their 2 or 3 big data centers. Like if you go out to Queens, there's a big green tower out there that I lived in for 8 months, and people never ate lunch in the neighborhood. I couldn't believe it. They come in on the subway, they fill up the building, the Bronx. No, that was Queens. That building's in Queens. And then they flush out of there, just like they do in the Trade Center at night. Nobody even eats in the neighborhood. People, I couldn't believe, my crew and I, we'd always go out in the neighborhood. But there were people there who worked there for years. They never even left the building. They would commute in on the subway, come across the East River, the Hudson, and they run up this building. They never even ate lunch outside the building. That's how isolated, this is the insular thinking that goes on in some of these places. But, like I said, you go out to that building, I think there was 2 major data centers in that, in Citicorp Plaza out there in Queens. But if you go, like I said, in Manhattan, then they had 33 processing centers there, and you have to figure out some way to make all these networks merge and collapse and integrate together and work, and then make some sense of what the bank's actually doing. Probably Citigroup's biggest problem to this point has been that was impossible, right? They had acquired over such a short period of time so many different entities, so many different computer technology platforms. And it's not like, in a bank, in a financial system, just like in any major industrial corporation, the network or the banks and financial institutions more than any other entity are nothing but their information technology structures surrounded by buildings. Okay, that's all they are, is their electronic networks. They are nothing else. It's the IT structure that makes anything and everything real, which is unreal for a bank or a financial institution like Merrill Lynch. Merrill Lynch was the project I completed just before Citigroup, and they were, again, that was when, from '96 on is when my thinking started to evolve that, you know what, and the more we started getting into derivatives applications, pretty soon it just got to the point like I wanted to run out of there like my hair was on fire, literally, because you could see that what was happening here was going to result in a huge pileup, and it was going to be extremely, extremely bad because of what was happening. But anyway, with Citigroup, if I remember right, I think there was 167 different platforms. That's basic platforms. There was